So let's remember the steps then. First of all, you have to pass the criteria, then identify the contract, written, oral, just business practice. Then look at what your distinct performance obligations are, your distinct promises. Remember, they are things that can be benefited from a loan or with other resources, that they are separately identifiable and that they don't rely heavily on other things. And then you look at the transaction price. And the transaction price is the amount that you expected to receive. Don't include VAT, use the most likely outcome. Make sure that that amount has no high probability of significant reversal. Put in the time value of money if it's more than 1 year between the date that you pass control and the date that you receive the cash, and that there's a significant financing component. So there's a big difference in dates or big interest rates or a big difference in amounts. And when you do that, you use the incremental borrowing rate. If it's less than a year, don't worry about it. And any revenue recognised that's no longer collectible, then you simply put in an impairment.